Good afternoon, everyone. I am John Cortale, and thanks for joining today's webinar on Social Security. I get a lot of questions from clients regarding this topic. Number one being, will Social Security even be there when I go to file for my benefit? Should I file for my benefit at 62, or wait to my full retirement age, or even wait to age 70? How about if I wait, how much does my benefit grow each year? Well, today we have Danny Cohen, Senior Vice President with John Hancock Investments, answering these questions and helping us navigate Social Security so we can get the most out of it. Danny and I have worked together for many years, and he is Social Security accredited. So Danny, please take it away.
Good afternoon, everybody. Can you hear me, John?
Yes.
Okay, perfect. Just want to make sure. All right, you should be able to see my screen here. So I hope everybody, like I said, is having a nice afternoon. Thank you for joining John and myself. And John, thank you for having me today. I think, as you said, Social Security is a complicated topic, but a lot of people want to know about it. I know many of you on the call here today are probably wondering, or at least want to know, when you should take your Social Security benefit or your spousal benefit. I don't necessarily have the answer for you. I think obviously you'd have to sit down with John, or at least get a better perspective on your own situation in order to answer that question. But what I am going to do is give you a sense of some of the rules and some of the changes and make you feel more comfortable about Social Security and the benefit that might be coming to you if you're not taking it already. So you might hear a little twang in my accent. Most people think I'm from New York. I think John still thinks I'm from New York, but I'm actually from Canada, which is like another planet for most people here in Washington, D.C. area. I grew up in Montreal, so the good news is we won't be doing this presentation in French today. It'll be in English, so you'll be lucky enough to be able to follow along today. So I'll discuss the roots of Social Security, where Social Security stands today, the 2020 changes, and then maximizing your Social Security benefit. So the first question I typically get, or at least what's on people's mind, is how did Social Security basically come about? Well, in 1935, the Social Security Act was signed into law on August 14th, and then in 1937, taxes were collected for the first time in January, and then in 1940, there was regular ongoing monthly benefits started in that January. Most people want to know who was the first person that collected Social Security, and that distinction went to a lady by the name of Ida Mae Fuller out of Ludlow, Vermont. What's interesting about her situation is she was a legal secretary and she retired in November of 1939, but she lived to 100. And what I was saying is interesting about that is the life expectancy at that time was 65. She lived to 100. She passed away in 1975. And then over the course of her lifetime, she collected about $23,000 in Social Security benefits. So Social Security really did work for her. And as you could see, it did actually work for the program in the sense of it was supposed to provide a retirement income to an individual, as it did. Some of the statistics you want to know about Social Security. So there's 63 million people receiving Social Security benefits. Today, nearly 9 out of 10 people age 65 or older are receiving benefits. 61% of Social Security recipients receive 50% or more of their income from Social Security. The Social Security Handbook has over 2,700 separate rules governing its benefits. The good news is I will not be going over all 2,700 because I'm sure you'd be falling asleep pretty quickly. And then there are approximately 1,450 Social Security offices in the United States today. Unfortunately, they're all closed given COVID, but Social Security offices receive 480,000 calls a day and 180,000 visits typically per day with an average wait time of 3 hours. So I tell everybody on these calls, if you hate somebody and you really want to pay them back, tell them to go down to the Social Security office. The wait won't be too long. I think a 3-hour good wait for somebody you don't like is good. If you call, it'll probably be somewhere between 20 and 45 minutes, depending on how busy they are or what time of the day you call. They are a very good resource as far as calling them, so you will eventually get somebody on the phone. Where does Social Security stand today? Well, most people will tell you, as John kind of started off the call here, that it appears to be in financial trouble, but most people think that it will be fixed. It's too important of a retirement benefit for people that most people think it will. But it won't grow fast enough, and that's some of the legislation you're reading about right now. And why are these the issues? I mean, if you look back, as I mentioned as I started here, in 1935, the life expectancy of a person was 65 years old, and Social Security at that time was only intended to cover retired workers. And there was about 160 workers per recipient working towards that. As of last year, you see the life expectancy is 85, but not only is it covering retired workers, it's also covering spousal benefits, survivor benefits, disability benefits, and you see now you're left with 2.8 workers per recipient. So it does leave a gap. You could see here in 2010, we started paying out more in benefits than we collected in tax revenue. And this year is the year where the trust reserves grow. And then in 2035, the concern is without some kind of plan to put in place to supplement some of the money that's in there right now, especially with COVID, the trust funds will be depleted by 2035. With COVID now, some people are talking earlier than 2035. And then at that point, the program will only be able to meet 75% of the obligations. The good news is, and the positive, is you know that there are going to be things to strengthen Social Security to come. As I mentioned, it's too important. One of the ways that could change is just by raising the full retirement age. Right now, if you're born before 1960, basically 1943 to 54, your full retirement age is 66. And if it goes up by 2 months from there, and then in 1960 or later, your full retirement age is 67. In 1983, they made a change. They could easily change that to 68 for your full retirement age, and that would create some additional monies in there. You could have a longevity index. As you know, Social Security pays out for the entirety of your life. They could change that just in the indexing of how long they think you're going to live. The one that's talked about most recently is the increase in the payroll tax. It's currently 137.7, and we'll talk more about that. But there's a proposal from President Hopeful or President Trump. Both of them have a Social Security plan, but Biden has a plan where what they call the donut hole, which is right now the first 137.7 is taxed. And Joe Biden has said that going forward, if he does become president, that anybody who makes over 400,000 will be taxed at that point. So there'll be a gap between 137.7 and 400. And then at 400,000, it'll pick up again for taxing the higher earners. What they could do is they could also increase the payroll tax from 6.2%. Most people think it'll be a combination of these different things in order to solve the issue. So the good news is if some of you are thinking that there's going to be an issue by the time you get there, I don't think there necessarily will be, but that's just one person's opinion. As you can see here, Social Security wasn't necessarily intended to be your entirety of your retirement plan. You can see the percentage of pre-retirement income replaced by Social Security. There's definitely an income gap in blue, and that's one of the reasons why I mentioned on all these calls it's important to talk to a financial planner, somebody like John, to really discuss your options of not just Social Security, but other retirement income sources. And, most people are not necessarily understanding that Social Security doesn't necessarily keep up with the cost of everything. So they tell you there's no inflation today, but I'm sure many of you have been in the grocery store recently and have gotten to the cash. And if you're a family of four, have probably noticed that your grocery bill is anywhere from $250 to $400. And you're probably thinking, okay, what are they talking about? No inflation. I'm married with 2 kids, and I tell my wife every time we go to the grocery store, listen, stay away from the blueberries, the strawberries, and the raspberries because they cost a fortune. Let's go down the chip aisle and pick up some Doritos and Ruffles. Yes, it's unhealthy. We might die sooner, but at least we'll have some money left in our pocket. It's just quite expensive, as everybody knows, when you head to the grocery store. And, of course, the cost of education is well ahead of what Social Security is today. So what are the changes in Social Security. A lot of people want to know that for 2020. One of them is the cost of living adjustment. Typically, every year you get a cost of living adjustment. It doesn't necessarily mean it's positive, but this past year it was 1.6. That number typically comes out in October, and you'll notice this year for 2020, it actually increased the average retired worker's amount by $24 a month. May not sound like a lot of money, but if you're retired, you all know that every dollar counts every month. So as I mentioned earlier, the $137,007 is the maximum earning subject to Social Security. It increased from $132,900 in 2019. And then you'll see that really when you look at your paycheck, and most people don't necessarily understand this. I didn't. When I came out of college, I looked at this FICA tax on my check, and I remember calling my father and saying, "Hey, Dad, who's this FICA guy? Because it seems like he's taking money out of my paycheck." I didn't know I had a partner when I started working. What's the story? And I mentioned to you I'm from Canada, so when I moved here and started working in my 20s, I was kind of wondering what that tax means. So the FICA tax, just so you're aware, is a combination of that Social Security tax that's being withdrawn from your paycheck, which is the 6.2% you see here on the slide in the middle. And then, of course, the Medicare tax that you pay is that 1.45. You take the two of those together, and that's how you get this 7.65. The Medicare tax covers Part B of your Medicare, and Part D, which is basically your doctor's visits and your medication. And then you'll see for self-employed individuals, for those of you who want it to be your own employee or your own business, this is where they haircut you. You have to pay both the tax on the employer and the employee portion. So the total maximum payroll there, if you take the 7.65 and you just multiply by 2, that's how they're getting the 15.3. So being a small business owner sometimes is not so much fun, and we always tell people consult your tax professional and see how the change will affect you, and then make any necessary adjustments to your budget. So that's how the FICA tax works. Just to kind of give you a summary of what this looks like from 2019 to 2020. At full retirement age right now, you would see that you would get in 2019, 34 and change. And then in 2020, you see that it's increased to 36,000 and change, which equates to $3,011 per month. Keep in mind that does not include the step up to age 70 if you delay. We'll talk about that here in a minute or two. You see the cost of living adjustment. It's not as good as last year, but that cost of living adjustment is very important. And then, of course, I talked about the taxable income limit. And lastly, keep in mind that if you are working before full retirement, you are going to be subject to an earnings limit, which is $18,240. You'll see that here. And in your full retirement year, they increase that amount to where you're allowed to earn up to $48,600 in your full retirement year before being penalized. You'll see at the bottom, as of 2018, Social Security only sends paper statements to clients 60 or older who aren't currently receiving benefits and don't have an online account. So one of my suggestions to everybody is to go on to socialsecurity.org, socialsecurity.org. Some of you may know it as ssa.gov. I would tell you that you might want to plug in socialsecurity.gov rather than ssa.gov. If you spell ssa.gov backwards, you might end up on a website you didn't intend to, and it might provide a nightmare for you if you get on that website. So long story short, socialsecurity.gov. I will tell you that if you have froze your credit, meaning you had an identity theft situation. I had this situation personally. I had an identity theft situation last year. I had to freeze my credit. I cannot open an online account with Social Security now. So what I had to do is print off a form off the Social Security website, mail it in, and then 3 weeks later, I got a Social Security statement. So you can do that. If you have a spouse, they can still do it as long as their credit is not frozen, but you're not going to see your benefit, of course. You'll see their benefit. So changes, restricted application. This is just really a planning opportunity, but very important conversation. I would say to anybody on the call who is born before January 2nd, 1954. January 2nd, 1954, you might have some options as far as switching from your own retirement benefit to your spouse's. The restricted application was a leftover rule from the 2015 bipartisan bill that Obama passed in the fourth quarter of 2015. It changed the rules on Social Security. There's no more file and suspend, but the one good thing that was left for people who are grandfathered in was this restricted application. So as I mentioned, if you're born before January 2nd, 1954, you definitely want to talk to John as soon as possible. Even if you filed, in the last year, you definitely still want to talk to John if you're born before 1954. Of course, you can only implement a restricted application if you're at full retirement age, and only one of you can. But I'm not going to spend too much time on that today because we'll get into the weeds if we do, but just something to take note of. All right, maximizing your Social Security benefits. So hopefully I can answer some of the questions as far as, what you're thinking on your own benefits, your spousal benefit, survivor benefit, and of course, divorce benefits. And those are the things we're going to discuss today. What makes you eligible for Social Security? So you do need 10 years of working, which is 40 credits. They give you 4 credits per year. I got a question on a call a couple of weeks ago from somebody that said, look, I've worked 9 years and 6 months. Can I go back to work part-time and get the remaining credits I need, the 6 months of credits? And the answer is yes, you can. Some people ask, okay, well, what if I was working 20 years ago and I'm receiving Social Security benefits? I have higher wages now. Do they reflect it in today's wages? Yes, they do. Your earnings are restated in terms of today's wages to reflect the wage growth. How they figure it out is they take your highest 35 years of earnings, they're averaged and divided by 12, which then arrives you at what they call your AIM, which is your average index monthly earnings. I'm sure most of you have a pen and pad and wanted to write that down. You don't necessarily need to, but the formula does work. You may ask, okay, well, what if I only work 25 years? I say only, but 25 years is a long time. What they do is they add zeros for the remaining 10 years, and that's how they calculate the 35 years. We also get the question, well, what if I'm still working in retirement, meaning I've already worked my 35 years, and now I'm working on year number 36, and my year number 36 is a lot higher than, let's say, my year 1. They will calculate that into the computation, and they will start paying you a slightly bigger benefit monthly as you're in retirement. And you see, lastly, a Social Security benefit formula is applied to your AIM to produce what they call a primary insurance amount, also referred to as your PIA. I'll refer to that today on the call. The PIA, the acronym, as I said, means primary insurance amount, which is the benefit payable to you at full retirement age. Some people call it your full retirement benefit. Some people call PIA. It means the same thing. So as we move along, the meat and potatoes of what you want to see here. So if you are taking notes and you want to see this, you're wondering what is my full retirement age? Between 1943 and 1954, your full retirement age is 66. And then you could see it goes up by 2 months, which I was talking about earlier. And then at 1960 or later, your full retirement age is 67. All right, so we're going to take an example and show you how the earnings limit applies in the case of 2 couples. You'll see the Smiths and the Sullivans. You can see it took John Hancock 3 weeks to come up with these names. They're pretty generic, right? We'll give you a sense of what the situation here. So keep in mind for when you're over the limit, for every $2 earned, you lose $1 of benefit. And I'll say that again. For every $2 earned, you lose $1 of benefit. So here's an example of the Smiths and the Sullivans. We'll use the Smiths in the case of them taking benefits early at 62. What happens in their situation? So their Social Security benefit, you can see here, is $20,000. And their earned income, meaning their W-2 income, their 1099 income, your earned income from work. This is not your 401k plan, your investments. It's not included in that. They take the $40,000 and they subtract the $1,840, because that's what you're allowed to earn before full retirement age. and you end up with 2176 over the limit, as you can see here in purple. And then because I said $2 earned, what they do is they divide by 2. Not that you have to figure out all the math, but it ends up with an actual benefit of $9,120. So the truth is, by taking early and still working, the Smiths lost $10,880. So it is a sizable amount. The good news is, which most people don't know, is you do get that money back when you reach full retirement age and you file. Because, excuse me, you've already filed, but when you reach full retirement age, you will get that back. It's prorated into your monthly pay. And then you'll see in the case of the Sullivans, where they filed at full retirement, there is no limit. They can earn whatever they want, and thereby there's no reduction in their Social Security benefit. So now you get a sense of how this earnings penalty works, but as I said, you do get it back when you reach full retirement age. All right, so your Social Security statement, it's going to show your earnings record. For those of you who haven't seen this, you definitely want to look this over, because if you have a year where it's not showing correct earnings, you have 3 months and 15 days basically to repair that situation. So you definitely want to call the Social Security office and let them know that maybe one of the years or something that you've seen on the statement does not seem correct. So you definitely want to make that call. How you read this, the first number that you see up top here, the 1,018, that's if you take early at age 62. The 1,476 is if you take it full retirement age. And then lastly, if you delay it to age 70, which we'll get in here in a minute, you'll see you receive 1,840. So that is pretty much your estimation when you see the statement as to what you're going to receive. Now, that question does come up again, when should I take it? And it really does depend slightly on how long you think you're going to live. You can see here in green that there's a 50% chance of males living to 87. And then, females tend to live longer, and you can see it here in the math, 25% chance of living to 96. So you definitely need to do some planning when it comes to deciding whether you should take early or you should delay. Okay, what everybody wants to know, which is, okay, what happens if I do take early? All right, so here's a sample, and we're going to assume full retirement age here just for fun is 66. It says 66, 67. So in this case, the person had a primary insurance amount of $2,000. And the question then becomes, what if I take it at 62? Well, you automatically get a 25% reduction in the amount you receive, which is how we ended up with the $1,500 that you'll see here on the right. If you take it between 62 and 66, there is a reduction in between 75 and 100%, but you get the idea. You lose 25% here, so it is substantial. And you'll see here the maximum benefit at full retirement age in 2020, which we discussed earlier. That's if you're taking it full retirement age, you can get a sense of what that is. If you delay it, and this is really the benefit of delaying, you'll see it says 132% of the benefit, which would get you to 2640. I will tell you, ladies and gentlemen, there is no CD or bond that gives you a guaranteed step up from age 66 to 70 for 4 years at 8%. So the delay definitely is a big benefit, and you can see the math does work very nicely. All right, so most people want to know, delaying benefits, what's the difference in the amount of money? And I'm just going to let this slide kind of fill itself out. You can see in this case, this was an example of $24,000 with annual benefit of full retirement, assuming a 1.5% cost of living adjustment. The big thing here is look to the far right at age 70, you're ending up with a $528,000, assuming that you live to 85. And the break-even point is really what most people want to know when it comes to this conversation, and that is if you file at 62 or 66, the break-even is at 78, and then if you wait to 70, the break-even is at 82. So it's about a 12-year time frame. So if you're living to 95 in this case, in their example up top here, you can see what you're ending up here in green. And if you live to 95, you're obviously going to be doing a lot better by waiting. Now, if you have heart disease or something going on in your family that you don't think you're going to live too long, you might want to take it early because you're not going to live long enough to actually benefit from this. if you get a sense of what's going on with this and why there's some planning opportunity. All right, the spousal benefit. This is usually where I get the most questions. The first thing I will tell you is that in order to get the spousal benefit, the higher earning spouse, or the spouse that is filing, I should say, has to file first in order for the spouse to get the spousal benefit. So a spouse cannot walk into the Social Security office and say, hey, I want my spousal benefit, without their spouse filing first, unless there's a divorce situation, which I'll talk about that here in a minute. But for this time being, just realize that the spouse needs to file first in order to get the spousal benefit. You still get a reduction if you file early. You can see it's a little bit of a different formula. It's 35% of the full retirement benefit, which is 35% of $2,000, which is how we get that $700. But you'll also notice if you delay, you don't get a step up. So at full retirement age, you're entitled to 50% of the spouse's PIA, which is the $2,000. 50% of that $2,000 is how we're getting this $1,000. So 50% of that $2,000, you end up with $1,000. As I said, if you delay it, it doesn't benefit you. So in a lot of cases, people want to take it right when they reach their full retirement age. Now, you can see it here in the bars. You don't get the step up after 66 in the full retirement space. And then, of course, then we get into survivor benefits. So at death, the surviving spouse will receive the greater of, their own benefit or the deceased spouse's benefits. Your full retirement age for a survivor benefit may be different from your normal for full retirement, generally the same or more favorable. So that's something to discuss. And of course, early benefit elections reduce benefits for both lives. I'll show it to you a little bit different. I think if you see the map this way, it might be a little bit more helpful. So in a death situation, it does allow you as the surviving spouse to take the benefit at age 60. You don't need to wait to 62. You do if you're living, and you will see that here. And you see, if you do take it at 60, you get 71% of the full retirement age benefit. The big difference between the survivor benefit and the spousal benefit, because a lot of people get confused on this. When you have a death situation, you can switch up from your own benefit to the survivor benefit or the survivor benefit to your own benefit. And I'll cover that in a second, but I want to go back for a second to that spousal benefit, because a lot of people have confusion here. 2015 changed the rules. So if you have your own earnings record and you have the ability for a spousal benefit, you have both, meaning, and your spouse has filed for their benefits, and now you're saying to yourself, okay, I want to go into the Social Security office at 62 and I want to file for my spousal benefits. What's going to happen? Well, you're going to be subject to what they call the deemed filing rules. And what that means is the Social Security Department is basically going to say, okay, well, we're going to give you the greater of the two, your own benefit or your spouse's spousal benefit. So it's the greater of the two. You do not have the option of choosing. You don't have the option of switching at that point. So that's a big distinction between the living side of it and the survivor side of it. In the survivor situation, as I said, and I'll repeat this because it can get confusing, and I'll give you an example. Let's just say that you're 60, you're married to somebody who's 62. They pass away, unfortunately. You have your own earnings record as well. You say to yourself, okay, you know what? I'm going to take the survivor benefit right now at 60, and I'm going to allow my own benefit to grow to age 70. So remember, from age 60 to 70, your own benefit is actually increasing by 8% a year. So that's where you could switch up. And then at age 70, you would stop taking the survivor benefit and then you would switch to your own benefit. And there's an example in here to kind of go through that, but that's pretty much how it works. So those of you who are maybe getting confused, what's important to realize is that when there's two living people, the Social Security office is going to give you the greater of the two. When there's a death situation, you do have the ability to switch up. Keep in mind, if you take early, regardless of whether it's survivor, spousal divorces we're going to cover here in a second, you are going to be subject to a penalty if you take earlier than your full retirement age. And then, of course, there'll be an earnings limit as well penalty if you take early and you're over the earnings limit. So those two things will apply throughout all the benefits. And I think that's typically where people have some confusion. All right, let's talk about divorce. You must have been married for 10 years or longer. So I'll say to any of you, if you hate your spouse and it's 9 years and a half, try to live in the basement or make it work until year 10 because you want to make sure that you have the ability to collect your Social Security benefit. You must be currently unmarried to receive it, and the divorce decree must be for 2 years. You need to be age 62 to receive spousal benefits or 60, as you saw on the survivor benefit. Your ex-spouse must be at least 62 and worked 40 quarters to receive that spousal benefit. And you'll see here, this is a big one. If the ex-spouse remarried and the client does not, the client remains entitled to the spouse and surviving benefits of an ex-spouse. So this is important stuff. So something to think about. Congress realized that, when people got divorced, one spouse may say, hey, listen, I can't stand you. I don't like you. You're not getting any of my money. I'm not going to file for benefits, so thereby you're not going to get any. So in a divorce situation, the ex-spouse does not need to file first in order for the divorced person, the ex-spouse, to get their benefit. You can go into the Social Security office and receive your spousal benefit, even if your ex has not filed. So that's an important distinction. Those of you who remember Johnny Carson back in the day, Johnny Carson was married to 3 different women for 10 years. So all 3 of those women are actually collecting benefits off his earnings record. And your question might be, well, what if I was married, I was collecting off a spouse, then I got divorced, and I got remarried, and now all of a sudden I don't like that person and I get divorced again? Can I switch back to my first spouse because my first spouse had the higher earnings record? The answer is yes. You can switch back, but if you are married, you cannot, right? So if you're divorced and then you get remarried, you lose the benefit on the first spouse. In a survivor situation, what happens is if you remarry before 60 in a survivor situation, you lose the ability to collect off the survivor, the spouse that deceased, and you would start collecting off the new spouse before 60. So a lot of widowers wait to age 60 before they remarry because then they can still collect off the first spouse. So I'll say that again. A lot of widowers, people actually wait until 60 to get remarried because they might want to still collect Social Security benefits off the higher earning person, and that might be the deceased spouse. So that gives you a sense of how that works. Okay, now, Social Security elections as we're moving along here. Why would you want to, what do you need to consider in order to wonder when or how you should take it and how long? So, question first is, do you need the income? What does your health look like? I talked about that earlier. If you have heart disease, let's say in your family, you don't think you're going to live long, you probably want to take it. Longevity, right? That's part of it. Are you married? And then you'll see here the age difference between spouses. So you'll see here at the bottom, the greater the age difference, the longer the benefit payment and the bigger the impact when making an early election. So remember, if you take early and you pass on, that's pretty much what your surviving spouse is going to get. So you definitely want to think about, if you delay it to age 70, what that higher amount will be. And then, you want to think about the loved one that you're leaving behind and what they're going to be collecting for the rest of their life. Okay, now, you may be listening to me with my Canadian/New York accent and be thinking, okay, you kind of caught my ear with something and think maybe, hey, I did something wrong. Well, the good news is that you do have 1 year to do what they call a do-over. There's no interest or penalty to pay it back to the Social Security Department. It's called Form SSA-521. You definitely want to talk to John about that if you have that situation. You may have heard me talk about the restricted application, and you had already filed, that might be a reason why you might actually want to do a do-over. Taxes. Get a lot of questions about taxes on Social Security. So what counts as what they call combined income? It's also known as provisional income. Combined income and provisional income basically mean the same thing. For Social Security taxes, that's your adjusted gross income, which includes, your retirement plans, your income. It does not include Roth IRAs or Roth 401ks. Anything after tax money like that is not included. Non-taxable interest is like muni bonds as an example, and then they compute half of your Social Security benefits into the formula. So the good news is that if you're in the 37% tax bracket, you are not being taxed at 37% on your Social Security benefits. How it works, as you can see here below, is the first $32,000 joint they don't tax you on, and then between 32 and 44, which is 12,000, they take $6,000 because it's 50%. And then anything over 44,000 from this computation that we talked about up here, they tax up to 85%, and then that gets put into your overall taxes. So if you're in the 15% tax bracket, you still might be, but you get the idea of how this works. It's a little bit more complicated. I think if you have a situation where you have more questions, maybe a call with John and myself, or specifically with John and your accountant, that might be a good idea. Okay, so we're finishing up the presentation, and I think we're doing pretty good on time here, just from the standpoint of examples. So we're going to take Harry and Ruth Sullivan. Their situation is Harry's full retirement age here is at 66 with $2,000. Ruth, in this case, had stayed home and raised the family, so she has no earned benefits of her own. And of course, we're going to assume a 1.5% cost of living adjustment at the top. You'll see Harry in these scenarios. Harry dies at 76, unfortunately, and Ruth passes on at 88. So what happens if they both file early? Let's go through this example. So Harry's monthly benefit at 62 gets reduced from the 2,000 that we saw by 25%, so he gets 1,500. And because Ruth took early, she gets 35% of that 2,000, not 35 of the 1,500, because it's 35% of the full retirement amount, the PIA, which was 2,000. We end up at 700. Harry passes away, we said at 76. So what happens? Ruth collects 100% of Harry's benefit, which was 1,500 at the time of death. And then the cost of living adjustment, you can see, increases the amount. And then at the bottom, the total lifetime of what she collects is $445,000. Okay, what happens if they take it full retirement age? Harry's monthly benefit at 66 is $2,000. And because Ruth waited to 66, full retirement age, she gets 50% of Harry's $2,000, which is how we got that $1,000. And then same scenario, Harry passes away at 76. Ruth collects 100% of that 2,000, which is 2,000. And then, of course, the cost of living adjustment, and then you see the total increase. It's a substantial amount from 524 to 488. Okay, now, what happens if they delay? So if they delay, what happens here, Ruth's monthly spousal benefit would be 50% of Harry's at 70. So Harry begins, as we said, at age 70, he delays it, he gets 2640. Once he files, Ruth can file. That's why she gets the $1,000 at age 70 and not at full retirement, because she had to wait for him. And then at 76, Harry passes. She collects the higher amount at death, plus the cost of living adjustment. And then you see, instead of getting $524,000, they get $567,000 plus over the course of Ruth's lifetime. So I'm not going to go through the restricted application. I think it's a little bit complicated, and just in the interest of time. But like I said earlier in the presentation, you want to talk to John about that. So lastly, considerations before you file. Will your benefits be coordinated with those of your spouse? Are you planning on working in retirement? Have you planned for how your required distribution, minimum distribution, will affect your income mix and Social Security benefit? And lastly, do you have a retirement income tax strategy? And that's why I had mentioned to you it's so important to talk to John when you're talking about planning for Social Security. So I'll stop there. John, I'll turn it back over to you, see if there's any questions or something that I missed.
Danny, this information was really insightful. I wanted to just follow up and clarify. It's a very common question I get regarding spousal and survivor benefit. So survivor benefit, you're able to take at 60, and with that, you're able to take the survivor benefit and allow yours to continue to grow, and then you could switch to the higher amount. Is that correct?
That's correct. Yes, and that's the big thing, unfortunately, for people on death. I mean, it's a good thing from a Social Security standpoint, but obviously from the passing, it creates some issues. But the point is you can delay your own retirement benefit at that 60 and take the survivor benefit, and then at age 70, you can switch.
And you're not able to do that on a spousal benefit?
No, because what happens is you have that deemed filing rule. What some people get confused about, and this kind of goes to your question because somebody's going to think of this after, is saying, hey, listen, my spouse hasn't filed, but I have my own retirement benefit. Can I take my own if my spouse hasn't filed theirs? So the answer is yes. You would walk into the Social Security office, take your own benefit, and ignore the spousal because your spouse hasn't filed. You can't switch after, John, in that case. So that's an important question that comes up typically after the fact.
Great. Yeah, thanks for clarifying. That's just a common question I get from clients. So thanks again, Danny. Social Security can certainly be confusing, but it's great to hear tips from an expert. If anyone has any questions regarding today's webinar or would like for us to run a Social Security optimization report on your particular situation, reach out to myself or anyone on my team. We'll also be posting a replay of the webinar on our website in the next couple of days. Again, the website's thecortalegroup.com. Thanks again, everyone, for joining us. I hope you have a great rest of your afternoon. Thank you.